There is an old rule inside the intelligence world. The biggest dangers are usually not the loud ones. The real threats move quietly. The same rule applies to financial markets. Most traders are trained to react to noise. They wait for giant green candles that explode upward. They watch for sharp red crashes that signal fear. They look for chaos, speed, and volatility. But if you look at the silver chart right now, especially in the low 60s range, something very unusual is happening. Nothing is happening. The price is not moving. It drifts down a few cents, then comes right back. It moves up slightly, then freezes again. To most retail traders, this looks boring. It feels like the rally is over. It feels like the market has lost direction. However, when you look beneath the price and study the volume, the picture changes completely. This is not a quiet market. This is a battlefield. Over the past several trading sessions, billions of dollars in paper silver have been thrown at this market. Banks have increased short positions. Algorithms have dumped contracts aggressively. And still, the price refuses to break lower. It does not collapse. It does not even bounce. It simply stops. That tells us one thing. Someone is standing there. Someone extremely large. Someone with more financial power than the bullion banks. Someone who has placed a limit buy order so massive that it is quietly absorbing the global supply of silver without reacting at all. What we are seeing is the arrival of a mega whale. This is not a Reddit-style squeeze. This is not a hedge fund chasing fast profits. This is a long-term strategic buyer building a position that will permanently change the balance of power in the silver market. In this four-part investigation, we are going to track this buyer. We are going to use hard market data to prove that a massive transfer of wealth is underway. We are going to connect the AI energy crisis to the sudden disappearance of physical silver. And we are going to explain why a flat price combined with massive volume is one of the strongest bullish signals in any market. The market is not dead, it is loading, and you want to be positioned on the same side as the whale. To understand what is happening around the $60 level, you must first understand how smart money actually buys. If you or I want to buy silver, we log into our brokerage account and place a market order. The price moves slightly higher and we receive our shares. Simple. But if you want to buy $650 million worth of silver, which is about 10 million ounces, you cannot do that. If you placed a market order of that size, the price would explode to $100 instantly. You would destroy your own entry price through slippage. So, what does smart money do? They use an iceberg order. An iceberg order is an institutional trading method. The order book only shows a small visible amount, maybe 5 contracts, but hidden behind it is a much larger order, sometimes 50,000 contracts or more. Every time someone sells into those 5 contracts, the algorithm immediately reloads them. Sell 5, reload 5, over and over. The price stays locked at the same level. It does not move, but the volume surges non-stop. Sellers believe there is endless demand at that price. Eventually, they run out of supply, and when they do, the whale removes the order and the price jumps violently. This is exactly what we are seeing right now. Look at silver around the $63 level. Every time banks try to smash the price lower, it hits an invisible floor. It does not bounce upward, it simply stops. That stop is the whale absorbing supply. Based on volume over the last 48 hours, we estimate that a single entity has absorbed roughly 10 million to 15 million ounces of silver. That equals approximately $650 million to $1 billion in capital.
Who can do that? It is not a typical hedge fund. Hedge funds avoid commodities. It is not retail traders. Retail is exhausted. It is not bullion banks, because banks sell into rallies. They do not defend price floors. This buying footprint belongs to a strategic corporate entity, a company that needs silver not to trade, but to survive. A company that sees $63 not as expensive, but as cheap insurance. We are witnessing the largest accumulation phase of this generation, and the longer the price stays flat, the bigger the breakout will be once the whale finishes buying. What is happening right now is a transfer of ownership. Weak hands are selling to strong hands. The weak hands are speculators who bought silver at $50 expecting a fast profit. They are nervous. They see the price stalling at $63 and fear a crash. Every dip scares them. They sell into weakness, providing liquidity. The strong hands are calm. They have a long-term horizon of 10 years or more. They are buying every panic sell. This process is necessary for a true supercycle. It builds a strong foundation. A market cannot rise forever if it is built on speculation alone. The fact that silver is not collapsing after massive gains proves that the market has changed character. In past cycles like 2011 and 2020, sharp rallies were followed by violent crashes because demand was paper-based. When hype disappeared, price collapsed. Today, the hype is gone, but price remains firm. That tells us demand is no longer optional. Someone must buy. Most people see a flat chart and think silver is finished. Professionals see a flat chart with heavy volume and understand silver is being quietly cornered. Once the final weak seller exits, price discovery begins. Many people ask the same question. Isn't this just banks covering short positions? The data says no. First, timing. Bank short covering usually happens during fixing hours or near the market close. This buying is happening continuously across Asian, European, and US sessions. That points to algorithmic accumulation. Second, physical premiums. If this were only paper short covering, physical premiums would fall. Instead, premiums in Shanghai and US wholesale markets are rising. That means metal is being taken out of the system. Third, sector rotation. Copper is rising. Uranium is rising. AI stocks are rising. Silver is decoupling from gold and aligning with electrification metals. That indicates industrial demand. So who has $30 billion in cash, massive energy needs, and fear of supply shortages? Big tech. Microsoft, Google, Amazon, Meta. In Part 2, we connected the AI revolution to silver. AI does not run on clouds. It runs on electricity, and electricity runs on metal. A single ChatGPT query uses 10 to 30x more electricity than a standard Google search. As models improve, energy demand explodes. The grid cannot handle it. Tech companies are building their own grids, solar farms, data centers, storage systems, and silver is critical to all of it. BlackRock and Microsoft launched a $30 billion AI infrastructure fund. The entire annual silver mine supply is worth roughly $25 billion. One fund alone has more purchasing power than the entire mining industry. Solar requires silver, efficient solar requires more silver, and AI data centers run 24/7, requiring overbuilt solar capacity. Silver demand is accelerating faster than supply.
Big tech understands this. They are not speculating. They are securing raw materials. They are buying silver before the shortage becomes public. This is vertical integration returning. Just like Henry Ford owned iron mines, tech giants are securing metals. The silver they buy will never return to the market. It is dark inventory, and this creates collateral damage. Medical equipment depends on silver. Military hardware depends on silver. These industries cannot substitute or delay purchases. When supply disappears, prices explode. Jewelry becomes the relief valve. At higher prices, scrap enters the market. But scrap is slow. Demand is immediate. This mismatch causes price overshoot. Silver is becoming too valuable to wear. For investors, the strategy is simple. Draft behind the whale. Do not get bored, buy the base. Watch volume. Store physical metal outside the banking system. When the whale removes the buy wall, price does not rise slowly, it jumps. Above $65, there is no resistance, no memory, no supply. The price moves through a vacuum. This is the markup phase. Before the breakout, expect one final shakeout, a sudden dip on low volume meant to scare weak hands. Do not panic. The hardest part is holding during the rise. Selling silver for dollars at the start of a supercycle is a mistake. Silver is not a trade, it is a store of strategic energy. The story of silver in 2025 is not about inflation or central banks, it is about physics. The world is electrifying faster than it can mine metal. Scarcity is coming. By holding silver now, you are positioned ahead of the largest industrial buyers on Earth. The whale is done buying. The iceberg is melting. The vacuum is opening. Hold the line. Subscribe.